Welcome everyone to the investment banking video. The primary services of an investment banking is to bring new securities to the market, trading, brokerages, mergers and acquisition and other business activities. I again recollect bringing new securities to the market, trading and brokerages, mergers and acquisition and other allied business activities. What is meant by bringing new securities to the market? New issuance are primary offerings as in initial public offerings. First, first issued in the primary market, unseasoned offering or initial public offering, first sale of securities to the public. One problem with IPO is how they have been priced. Therefore, IPO suffers mostly from underpricing and at times from overpricing. But what is the realistic value? Probably this is very difficult to gauge. Seasoned offering, additional issues of securities already been trading and you are offloading a little bit of more securities, little bit numbers of more shares in the market. Offerings can be either through a public offering or private placement thereby. Talking about public offering, corporation wishing to make public offering must decide whether to have an underwriting, that is, the investment banker guarantees that the issuer will receive a fixed amount of money, whether the securities are sold or not. It's a guarantee that you are going to give. Best effort basis, investment bankers makes no guarantee and instead promises only to make its best sales effort put forward so that all the securities that has been launched or been offered in the primary market is been subscribed altogether. So corporation wishing to make an underwriting security can choose or solicit investment banking services through competitive bidding. Definitely yes, it can go for tender. The issuer publicly announces the desire to sell securities and solicit offers from several of the investing banking firms. Negotiated offering is direct negotiation with a single investment banker as on when on basis. There are three steps. Remember, wow, how many steps? Three steps. Three steps out to bringing a new issue to the market. As in one, step number one is the originations. During the origination process, the investment bank helps the issuer to analyze the feasibility of the project, determine the amount of money and type of financing, design of a security contract that is acceptable to the market, prepare the Securities and Exchange Corporation, Securities an exchange corporation registered statement and summary prospectus, obtain a rating on the issues, obtain bond counsel, transfer agencies, and a trustee thereof. Second is underwriting. What are we looking at? The underwriting of price risk bearing. The investment banking IB buys the securities at a particular price and resell it to the public at a higher price. This is what the underwriting is all about, it, wherein the underwriter guarantees the initial public offering made by the firm as a minimum amount to be achieved to be raised. Sales and distribution is all about selling quickly, reducing inventory as far as possible so as to reduce your risk. Syndicates are formed to reduce inventory risk. Market price declines cut the investment banking margins all the way down. Underwriting agreements in an underwritten offers, investment banking guarantees the issuer a certain price. The risk of not selling the issue at a price higher than that promised to be issuer is borne by investment banking. The difference between the price at which issue is sold and that promises the issuer is the underwriting speed spread per se. This is the profit earned by investment banking altogether. Remember, underwriting offer, the IB guarantees a certain price. The risk of not selling the issue at a price higher than that the promised by issuer has to be borne by the investment banker by himself. But in case if it can be sold at a higher price, that's the profit that the investment banking is going to get it. The difference between the price at which issues are sold and that promises the issuer is an underwriting spread. So, underwriting agreements in the best effort, the investment banker does not guarantee a price or that the issues will be sold. The investment bank is compensated based on the number of securities being sold. The risk of the securities not selling or not selling at the desired price is borne by the issuer and not by the bank, not by the investment banking. Smaller and more riskier issues resort to this type of offering, perhaps. So, trading and brokerages, the second aspects. Beside underwriting, investment bankers provide services as brokerages and dealers for existing securities. The brokerage functions is to bring buyers, is to bring sellers together for a commission. Dealer making market functions, buying, bid, and selling asks from an inventory of the securities owned by the seller thereby. And that is what we need to understand every now and then. Trading, the brokers and dealers can also provide security credit, which represents a loan to the customer with a margin thereof, what we are looking into it. So this is known as margin trading. The amount of loan that the bankers give it to the traders or to the investors for trading, for doing some security credits, is the margin account that we go around it. So margin trading means the investor can buy the securities partly with borrowed money. Example, if a customer uses 40% margin, it means 40% of the purchase securities is being financed by the investor's own money and 60% is been financed by the borrowed money from the brokerage house. Remember, this time the brokerage house can be the investment banking. Dealers' security credits are financed by the bank, call loans and repurchase agreement thereby. A full service brokerage firms offers a wide range of services provided by the licensed stockbroker or account executive. Storage or safekeeping of securities, execution of trade, investment research and advice, cash management and services. This is what a full service brokerage firm would be doing about it. That is the storage and safekeeping of the securities, execution of the trade, investment research and advice, and cash management services thereby. What about the discount brokerage firm? You will have a fewer non-fee services than full service broker, but will charge a much lower commission or brokerages, if I may say. Banks may act as a broker on behalf of its customer. Arbitrage activities involve the simultaneous buying and selling of securities to take advantage of the price that exists between two markets is another trading activity of investment banking. Example, if GMC stock is trading at $35 a share on a New York Stock Exchange and $34 at NASDAQ, an arbitrator would buy GMDC stock on NASDAQ and sell it in New York Stock Exchange. He will earn $1. This process will continue until the price differential is completely eliminated. Private placement, the sale of securities directly to the ultimate investor. No public offering as such. It is just a direct placement to the private entity. The underwriting function cost is completely avoided. The investment banker role is to bring buyers and seller together, help determine a fair price for the securities, and execute the transaction. For this, the investment bankers would be earning a fee wherein it mutually serves the sellers and the buyers together. That is what the investment banker jobs would be all about. It. This was all of third in first was of bringing new securities, second was of brokerages, and third is private placement. Remember, advantages of private placement: it is less costly in terms of time, in terms of money. That is, there's a reducing the total flotation cost for a business or a government. The extremes of high credit quality firms and low or unknown credit quality firms are using private placement. The terms of private placement are easier to negotiate and renegotiate. Disadvantages: securities have no readily available marketplace. They are less liquid. There is a small group of investors, and probably that might not be traded as randomly or as frequently as other scripts might be doing it. Next advantages working functioning of investment banking is mergers and acquisition. Investment bankers provide four categories of mergers and acquisition for which they can earn fee. First, help firm identify the M&A candidate, mergers and acquisition candidate, the one firm that wants to acquire and the other firm which needs to be acquired or needs to be merged because of some criteria. Do the require analysis to price the deal, provides advices, help acquire the acquiring firm in negotiating, help the acquiring firm in obtaining the funds to finance the acquisition, the purchase altogether. And that is what the investment banking would be whole and solely devoting itself to. So yes, It helps identify mergers and acquisition candidate, do the required analysis to price the deal, provide advise and help the acquiring firm in negotiating, help an acquiring firm in obtaining the funds to finance the purchase. Let us understand. Specialized investment banking department provides the following service as in arranging mergers which would pronounce as economic synergy or probably total increase in the wealth. Assist firms in fighting hostile takeover. Establish the value of the firm or the target firm. Then we have mergers and acquisition have been profitable aspects of investment banking. Then we have the consumer business have to have been extended in the mergers and acquisition department as and when on basis. So the last one of the investment banking business is other allied business activities. Remember, investment banking firms are very flexible organization, and if they can earn a satisfactory return, they can perform plentiful of services. Let's say financial consulting, as an example of assisting a client in financial planning, determining the firm's optimal capital structures and dividend policy, real estate investment and brokerages, purchasing real estate for investment purpose exclusively. With these words, I come to an end of this video. Thank you for watching this video till the end.